that out of the way, I'm extremely excited to introduce our first keynote speaker. Lyn Alden is joining us. She's a founder and managing director of Lyn Alden Investment Strategy, and she's a well-known guest on business television here in North America. Her economic views are phenomenal, and I'm really excited to hear from her about what's been happening with the CPI data. How is that impacting everything? How is money printing impacting inflation and all precious metals, for example? So I'm excited to hear from her. And the timing, of course, couldn't be any better because just yesterday we had the CPI data presented. So I'm looking forward to hearing from her. Lyn, thanks for joining us this morning. I really appreciate it.
So what I'm going to focus on here is the long-term debt cycle that is characterizing a large portion of what is happening to market movements around the world. It kind of sets the stage for the kind of the major backdrop that we're in and why this cycle is acting so unusual compared to what many of us could expect from the markets. And to take a step back for a second, first we have to, before we define the long-term debt cycle, it helps you define the short-term debt cycle. And so that's the normal 5 to 10 year business cycle that many of us are familiar with. And that's where, for example, we have debt build up in the system. So over the course of a business cycle, after we emerge from a recession, we start to get more and more debt building up in the system. Loans are being used, debt's being issued. It starts off healthy, but then, towards the end of that cycle, it tends towards excess. And then some sort of catalyst happens. It could be, a monetary tightening. It could be some sort of external event. But either way, something, impacts that rather leveraged, economy. And basically, we enter a recession period. We enter a deleveraging period. Now, however, deleveraging almost never gets us all the way back down to the same debt to GDP ratio as we started with. And usually policymakers come in with lower interest rates, fiscal support, and basically, to short circuit that deleveraging process. And so over time, when we string multiple of these business cycles together, what we see is that we get higher and higher interest rates, lower and lower interest rates and higher debt as a percentage of GDP. And so, for example, the chart on the left here has corporate debt as a percentage of GDP for the United States. And so we keep getting higher highs and higher lows as a percentage of GDP, while interest rates, of course, have been in a 40-year down cycle. The same thing we see that when we look at the federal debt cycle. So this is true for most sovereigns around the world. During those recessionary periods where you sometimes have some deleveraging, you tend to see a rise in the federal debt level to basically compensate for any sort of private sector deleveraging that's happening. And so as we string multiple of these cycles together, we get something called the long-term debt cycle, and that was popularized by hedge fund billionaire Ray Dalio, and it's a concept that I have used a lot in my analysis because I think it's very instructive for the period in history that we're in right now. And so this is a chart. Again, I'm focusing on the U.S. for a lot of my data, but most of this applies, to most developed markets because we're all kind of on the same drumbeat, more or less, just different magnitudes. Sometimes, some economies are shifted forward or back, maybe 10 years. We're all kind of following a similar direction. And so this is the federal debt in blue and the non-federal debt, which is mostly private debt, in orange, and both of them are as a percentage of U.S. GDP. And so what we saw is that, the 1930s, that's the last time we had a major debt bubble peak, and that's the private debt bubble. And we had a banking crisis, we had a bank recapitalization, we had a currency devaluation relative to the gold peg, and that was a very disinflationary environment for the most part. But then, as we stagnated throughout the 1930s. Then we entered the war period, right? So this was a rising period of global populism. All sorts of economic issues that were then fermenting all sorts of issues. Then we got, in many countries around the world, obviously, when we were having, military conflicts, we saw a really big ramp up in sovereign spending, obviously, and so most of what they were spending on was obviously war related, but a lot of that spending was building up their own industrial bases to facilitate the types of economy they needed to support that war effort. And so we would see, a federal debt go up very high, and it actually got so substantial, and inflation became so hot that they did yield curve control, where the Federal Reserve basically capped the yields even on the long end of the Treasury curve, and just prevented them from going higher. And the mechanism that they used was that they were willing to buy any treasuries that go over a certain amount. And so if yields went above 2.5%, they basically bought as many treasuries as were needed to maintain that peg. So even though inflation, got very high at times, they kept that peg, and that actually devalued the currency, inflated away lots of debts, And as we emerged from that, bondholders were not very happy, cash holders were not very happy, but they had more or less deleveraged the situation, and we kind of entered another cycle. And so if we, fast forward to where we are now, we're actually in a very similar situation where the 2008 period was the bursting of a giant global private debt bubble, whereas since then we've inflated a public debt bubble to kind of come after that, similar to 1940s in some ways, and that's also why many people are using the pandemic as an example of something that looks almost like a wartime economy, because even though we're not fighting obviously other military forces, we're fighting some big external thing that is triggering many countries to do large fiscal to extent that we've not seen since the 1940s. And that is of course relevant for a variety of asset classes over time. So what this chart shows is three things. So this is the broad money supply of the United States in blue, and that's the change over the past year. Then we have red is the Federal Reserve assets, again, change over the past year, and green is transfer payments. And so what we saw is that a lot of people ask, well, what makes this time different than a decade ago? And it comes down to that fiscal component. And so if you look back in the 2008 to 2014 period, we saw significant asset accumulation by the Federal Reserve, but it didn't translate into broad money supply increases because there wasn't any mechanism to get that into the broad economy. Most of that just went up to recapitalizing the banking system, and shoring up those balance sheets rather than basically handing more money to average people on the street. Whereas what we saw in this time was that QE ramped up mainly to monetize public deficits that we put directly into the hands of people, either through their employers or directly into people. Every country kind of did it differently. And so, we had a spike in broad money supply from many countries around the world, with the United States having one of the biggest year-over-year percent increases among them because we did one of the biggest fiscal injections. And this goes back to that long-term debt cycle that I was talking about, where if we look back in the 30s and 40s, first interest rates in orange here hit the zero bound. The monetary base as a percentage of GDP ramped up because that's the tool that they start using when they run out of room on the interest rate side. Deficits were pretty high during that period, but it wasn't until the 1940s that deficits totally ballooned, right? Because they're the war deficits. And then as you emerge from that, they kind of normalized policy for a while. We had another inflationary period in the 70s. And then over time, as we look forward to what happened here in 2008, it looks a lot in many ways like the early 30s, where you had the ending of this interest rate cycle. You had the central banks around the world turned to other tools, in this case QE, to expand the monetary base. But even then, deficits as large as they were, they weren't completely insane. It wasn't until the 2020s here, and this doesn't even include 2021 yet, which is going to have another giant gray bar, that the deficits start to look warlike. And that's again, something that makes this 2020s decade looking somewhat different so far than the 2010s decade. Extending that. So this is, people always debate what is the best way to measure inflation. And as Kai pointed out, we actually just got an inflation number that was, 2.6% year over year for the United States. We're also seeing it heat up in Germany. We're seeing it heat up in different countries around the world. And so that's basically a combination of a couple things. One is we have low base effects from the previous year. And so if you look back in the March, April, May period of last year, that was kind of the initial harsh lockdowns in many places, kind of the most deflationary part of the past year. And so when you do year-over-year comparisons, you have very easy numbers to compare to. And so that's actually one reason I like to look at other time frames to see what's happening with inflation data. And so what this is a 5-year rolling average, which gives us a more structural look at how things are looking. And people often debate, how to measure inflation. What is inflation? So this actually combines two different types of inflation. So the blue line is broad money supply per capita, and this is for the United States. And so this is, in some ways, raw inflation, monetary inflation. And so what we saw is that on a 5-year rolling average, the 1940s and the 1970s, and then going here into the 2020s, the dotted line is estimates for 2021. These are periods of great monetary inflation. That is more than just a 1-year blip. It's enough that you really push up the 5-year rolling average number. And then same thing, if you look at the orange line, that's consumer price index. And it's tricky because their way that they calculate that changes over time. That the basket of goods that over time evolves, and so that's one of the metrics that is often disputed. But either way, we do have figures that go back about over a century, and so we still have that data available to us to compare. And so what we see is that generally there's a pretty significant correlation between monetary inflation and CPI inflation. And so far, in the early stages here, we've not really seen that sharp CPI inflation, but that's something to watch out for as we get these low base effect numbers. We're starting to get a little heated now, and as we, different countries emerge from lockdowns at different time frames, especially as this broad money supply is still ticking up. This goes back to the 1940s that I talked about yield curve control, and that's where in the United States in the 1940s we had pretty high inflation. Many other countries had even worse inflation, especially countries that had more damage from the war. But this showed that yield curve control completely overrode the effect of inflation, and so the Federal Reserve kept even long-term yields, 10-year yields in this case, completely capped at 2.5%, regardless of what inflation did. And so as a result, anyone holding those treasuries, they made about 2.5% average per year. They felt like they make nominal returns, but they actually lost a significant amount of purchasing power, about a third of their purchasing power on an inflation adjusted basis. And so we're in an environment like that now, most likely, where central banks are likely to hold yields below the inflation rate, whatever that inflation rate ends up being, as best they can. And so this chart is another way of visualizing that. So the blue line is the 10-year yield over time on an annual basis, and the orange lines are the bars, I should say. They are the forward annualized return in real terms of 10-year treasuries from that date. And so we saw was that during this long stretch here, particularly the debt bubbles and then working through that, and then encountering the inflationary 1970s, treasuries persistently failed to provide increases to purchasing power, you could say. People made nominal returns from them, but they were not enough to compensate them for the loss of the currency strength. And only in these more disinflationary structural high yielding periods do you see that bonds actually provide returns that are above the inflation rate on a sustained basis. And to kind of wrap up, I can have a few charts here about gold, and because how this ties into how assets can perform. And so this chart has three main things on it. The blue line is the U.S. Broad money supply, and it's indexed to 100 in 1995, just for a frame of reference. Then we have the gold price that is also fixed to 100 in 1995, and the green line is real interest rates as measured by the 10-year yield minus the official CPI. And also the money supply is adjusted per capita. And so what we see is that, if you look back in the 1970s and into the really early 80s, that bull market that we're all familiar with in terms of gold, that really got its legs during periods where inflation roared, and specifically that it went much higher than the prevailing interest rates, and therefore drove interest rates negative. And so interest rates hit almost as low as negative 5%, as officially measured. And those are the two big spikes of gold during that period. And then we spent a multi-decade period where you had positive real rates from treasuries. So going back to that previous chart, you could put money in the bank, you could put money in treasuries, and you could make a real return on your money. And that made the opportunity cost of owning like a yieldless asset pretty high. And so we had a multi-decade bear market. But as money supply kept growing, as interest rates kept going lower and lower and lower, eventually getting into negative territory in real terms, we started to see this rise of gold. And of course, we got way ahead of ourselves in 2011, came back to trend, and then since then we've continued to follow broad money supply as measured by this way of looking at it. Zooming in the past 5 years, this is another way of looking at it. And so the red price is gold. I mean, the red line is gold price on the right axis. We see the big correction we've had recently. And then the blue line is the 10-year treasury minus the 10-year break-even inflation rate, which is basically the TIPS, the treasury inflation protected securities market. their estimate of forward inflation levels. And so that gives us kind of real-time daily reading on what the real yield of the treasury market is expecting itself to be. And we see that there's a pretty strong inverse correlation. And so, gold hit, a local bottom here in late 2018, when real rates hit their peak. We had this, big decline from, about over -1% real yields down to, below -1% real yields. We saw a strong rise in the gold price from 1,200 to over 2,000 in US dollar terms. But then, we've been in a correction because in addition to getting a little bit ahead of the broad money supply growth, we also had this, we started to have a rising yield environment. And so even though inflation's still been ticking up a little bit, real yields have actually been going up as well. And so we put some pressure on the gold price. And so we're looking forward to see what's going to happen now. So in many cases, we've had that rise in 10-year yields without the corresponding rise in official CPI data yet. But as we look now into the March data that we just got, the April data that we'll get in May, the May data that we'll get in June, we're starting to get into the period now where inflation is coming in somewhat hot due to base effects and due to reopening effects. And so we'll see how gold responds to that. But there's a good chance that real yields could roll back over a little bit and help gold kind of find support here. It's kind of what I'm monitoring. For my last chart, this is another way of visualizing the gold price relative to money supply. And this does it slightly differently. And so the blue line is OECD broad money supply M3. And so this takes into account not just the dollar, but also European currencies, Japanese currency. It takes into account many developed countries and basically tracks their broad money supply growth. And this one is indexed to 100 in 2015. And the orange line is gold's market capitalization. And so that's the gold price multiplied by the average annual new production rate of gold. And so because gold does have a small inflation rate in the sense that a little bit more gold is created every year, somewhere between 1.5% to 2% or more. It fluctuates over time. And so what we saw generally is, we see the same sort of trend. We were in this multi-decade bear market where gold, the whole market cap of gold went roughly sideways to down for several decades. Then it had a big reversal point. Since then, it's been keeping up with broad money supply, in some cases exceeding the growth of broad money supply. And so if we look back, for example, over the past 5 years, we can say that gold largely did its job in the sense that the gold price, the gold market cap, kept up with and even exceeded the broad money supply growth. And it's natural that we're, as we've gone up so far so fast, we're having a correction. But over time, we should continue to see broad money supply growth among major nations. And then especially if we get kind of a cycle peak in real yields, that can potentially give gold assistance, you could say, in finding a bottom and rolling back up. And so those are a couple of things I'm watching moving forward, and how I'm kind of interpreting this broad environment. And so that'll end my core presentation.
Lynn, this was phenomenal. Like I'm in awe actually, because it's really interesting to listen to somebody who takes out the emotion from everything. Like gold investors are extremely emotional, and listening to you like base it on the M2 and M3 money supplies is really interesting. And I do have a couple follow-up questions for you.
Sure.
And I'm wondering where I should start, because I took notes throughout the presentation, and I wish we had more time than just 9 minutes, but it's fantastic. So yield curve control is one thing. Like maybe let's start at the beginning of my notes. And one thing, that's a new term that's sort of been introduced, it feels like just recently again as well. And
Yes.
what does that look like? Like, and being like seeing the CPI numbers yesterday, is that indirect yield curve control? Because the tips just went down, the 10-year yields. It crashed. It's like, I wouldn't say it crashed, but it went down by a couple of points.
Yeah, so there's two different types. I mean, there's basically yield curve management, and then there's yield curve control. And so what we've seen in many developed countries is yield curve management. And so in Europe, for example, you see kind of unofficial spread control, where they're looking at the Italian 10-year, they're looking at the German 10-year, trying to keep that spread at, from blowing out. And so different places around the world kind of all do it a little bit differently. Only a handful of them at the current time are using actual yield curve control, where they draw a line in the sand and say, we're not going to let yields go above this number. And so the two that are really doing it that approach are Japan and Australia. And Australia is the more notable case because they're doing yield curve control on their 3-year treasury. And if you look at their yield slope, you can tell that the 3 years their artificial number, because it's like a depressed thing, and otherwise a normal curve. It's like this weird artificial peg. And so, but in order to defend that, they had to increase their balance sheet at a very, very rapid pace there, especially when yields were kind of trying to push up. Because essentially, if a country defines a yield target that they're going to defend, they basically give up control of their balance sheet. They have to, their balance sheet will go wherever it has to go in order to maintain that peg, if they're serious about maintaining that peg. And so I describe it as that there's no free lunch, which is that if they choose to set a yield peg that the market doesn't agree with, then the release valve ends up being the currency. And so you can control real yield. You can control your government bonds at the entire yield curve if you want, but you can't simultaneously do that and control the value of your currency. You can kind of choose one or the other. And so in those environments where they actually, from policymakers' perspective, they wouldn't mind some degree of currency devaluation. That's one of the tools that they can go to, and it's one of those things where it hurts bondholders, obviously, and it can be good for real asset holders.
Interesting. Yeah, like the CPI and the bond yield correlation is really interesting because it also, like, I was on a panel yesterday and the talk was that the minus 1% or the minus one difference between CPI and real bond yields is really important for the gold price. As once it crashes or it goes below one, or negative one, gold should be benefiting, as you said, real assets. Do you see that correlation as well? Is there like a hard number that you say that is a trigger?
I don't view an exact line in the sand. I take into account those two main variables, which is growth in the money supply, which is generally good for asset prices, especially when the yields are low. And then I look at the real yields. And there are, if there's closest to a magic number, it would basically be a little bit below zero, because if you look at gold, you can describe it as a zero yielding inflation hedged asset in a sense. But then it has, you can call it a minor negative yield because you have frictional costs of acquiring it. Maybe you're holding an ETF, you're paying expense ratio. Maybe you're holding it physical, so you had kind of a markup. Then you have security costs, things like that. So once you get down into some degree of negative territory on the real yields, that's where gold suddenly is a lot more attractive than holding bank account cash or sovereign bonds in that currency.
Yeah, I was like, the panel was extremely excited about the minus one or the negative one yesterday because it really seems to be that trigger for a higher gold price and shift of assets to a degree. Really interesting. As you said, like, you've been basing it on M2, M3, like gold price versus M2, M3. It's really interesting because it seems like we're still in an overheated environment based on your last few charts. Right. So of course I got to ask you, like, where do you see gold heading right now? Like, what is happening and how do you factor in now a second infrastructure package? Like, how does that all work into the current equation? And like, how do you even think about people saying, oh, we should be at $2,300, $2,400, $2,500 gold right now? If I see those charts, I think we should be at 1,500.
Yeah, so there's a tricky thing. One is, those charts, and if you look at, the two that I showed, they normalize to different dates. So, the OECD one normalized to 2015, and the other one normalized to 1995. And there are a bunch of different dates that people can choose to normalize it to. And so what that doesn't tell you exactly what gold should be, but it shows you what has gold done relative to a certain date that you're interested in. Has it kept up with broad money supply or has it not? And so that doesn't tell you an exact range, but it just kind of gives you an idea of how that's behaving relative to the broad money supply. And so some people might want to pick a different date. And also, if you were to get deeply negative real yields, as you saw, you can overshoot that broad money supply pretty significantly. And so basically, when you're in an environment where you're erring on the side of negative yields, I would err on the side of gold basically being over, that broad money supply growth rate. And so, there are times where it can get stretched, as we saw. But I wouldn't say I'm not going to buy it till it touches the blue line, for example. That's not the way I'm going to approach it. I'm going to say, okay, here it's getting a little bit heated. Okay, here it's getting a little bit closer. Here it went below it. It's actually, along with real rates, it's really attractive. And so it's kind of a hot and cold thing for me, rather than, it's got to follow this line exactly. And so when I look out over stimulus things, so I am using that as a way to measure what I think broad money supply is going to be going forward. And so, before these large fiscal environments, the main way that money is created is by bank lending. The banks have to lend in order to grow the money supply. But when you don't see that happening, it really, instead becomes how much is the government going to spend, and then also how much is the central bank going to monetize. And because if they issue bonds, they put money into the economy, and then those bonds extract money from the economy. Fiscal spending alone doesn't necessarily boost the broad money supply. At the same side, if the central bank just buys bonds and with new base money, that doesn't necessarily increase broad money supply either, because it doesn't send it to people. Is that actually one thing we see in Europe, where they're doing a lot of bond buying, but they're not doing a ton of fiscal spending compared to the United States, and so their broad money supply is going up somewhat slower, even though it's still going up faster than is historically normal. And so I look for that combination of fiscal spending and the bond issuance associated with that fiscal spending being bought by the central bank with new base money. And so I do see, over the next, say, 3 years, that we're probably going to get M2 growth of 10% higher or higher per year in the United States. And I would have different measurements or different estimates, I should say, for other countries.
Okay, fantastic. And we probably have time for about one more question here. And I was just going to talk about the gold market cap that you mentioned, which is really interesting as well, because I personally have a hard time grasping what the overall value is now with all the paper gold out there as well. So the paper contracts, how does that fit in? And how is this real price discovery? Because you use price, of course, in a lot of your charts, but with the paper contracts that are just astronomical and don't make any sense, like how does that factor in?
That's certainly one of the challenges, yeah, and that's also why I give a pretty wide amount of variance, and rather than saying it's got to follow this line perfectly, because you're taking into account a lot of other factors, and so I use that as kind of a broad, taking a step back, looking at the 50,000-foot view where we are, right? So does it look like a bubble? Does it look like a super buying opportunity? Does it look somewhere in the middle? And I kind of use that as a framework. I also can look at things like, say, the median US house priced in gold. And like, what does that look like over the past 50 years? So I can do different commodity ratios to basically take out the money equation and just focus on gold relative to other commodities, and kind of look at, say, the gold copper ratio over time, the gold lumber ratio, whatever the case may be, to kind of just find, what makes sense or what looks relatively stretched. And the fact that gold does have a large paper market, does potentially limit, as long as that paper market holds, some of the peaks it can get to, right? Because that can basically increase supply somewhat flexibly to satisfy demand. But there are kind of tail risks where, if that paper market were to break, then you can get a sharp move to the upside in actual gold, because the suddenly the physical becomes the main thing.
Fantastic. Lynn, it's so great for you to join us. I have a few more questions, but we can't get to them, unfortunately. I was going to talk to you about wartime spending and GDP impacts. How do you increase GDP and things like that? And what do you see there? But we'll have to get you back on. I really, really appreciate you joining us this morning. Thanks so much.
Thanks for having me.